The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick. These are your headlines. The dollar whipsaws after comments from President Trump sent it to a 4-year low against a basket of currencies as investors eye today's Fed decision and watch for hints on who will take Jay Powell's position as chair.
ASML beating on the fourth quarter bookings and posting guidance for the current quarter ahead of expectations, citing, yes, you guessed it, strong AI demand. And LVMH defying downbeat expectations with sales rising. All right, it was only 1%, but it was better than expectations, although fully operating profit falls by nearly 1/10.
We kick off the show this morning with a lot of currency-driven volatility, and all this on the back of comments from President Trump. I've got to say, they look like the most bland comments he's ever made on a topic, yet they've had market implications. And the lines here, effectively, when Trump is asked about the US dollar, he's made comments, I would want it to just seek its own level. I mean, there's not much in that, right? The other comment that the value of the dollar was great. Again, these are not obvious comments from Trump, but the indifference is what the market has picked up on, and some think it emboldens the sellers out there. So it's driven fairly significant swings in euro dollar, also the Japanese yen. We've been closely watching for intervention. There was some sort of accord between the Americans and the Japanese, and it's moved again, the metal asset classes. So it's had ramifications on what, of course, is Fed decision day too.
Lots there. Some I agree with what you just said. Some I'll beg to differ. I think the dollar yen's a sideshow compared to the bigger story about the dollar as well, but I don't think we're disagreeing about that. I don't think they are bland comments because, as everybody who's been a dollar watcher forever has pointed out, the US has never overtly advocated a weak dollar policy. In private, sometimes they've wanted the dollar down to make their export goods more competitive. But in public, the US, which runs multiple deficits, has only ever in public says we advocate a strong dollar policy. So I think what Trump is saying by insinuation is not bland. I think it's actually remarkable. And the markets, quite rightly, have continued to pick up on that. I wonder if Scott Bessent, when he's talking to CNBC later on, I wonder when the Fed Chair Powell is speaking later on as well, they will try to address this as well, because it is an extraordinary situation for a country. And I just did some work on this before the show. The US in the first 10 months of the year ran a deficit, and I've got the numbers in my head, just under $800 billion. It ran a trade deficit. So despite the fact that the October figure was way better than the year ahead earlier figure, and we don't know if that was because some inventory move or gold or what have you, but the fact of the matter is, net, the US is still running an enormous trade deficit, which was bigger actually than the first 10 months of 2024. Plus, you have obviously the fiscal deficit as well. So when you start worrying about sell America trade, I'm not worried about the equity side of things. I think that's something else. But if you are seeing a sell America trade on the dollar, which would then have a ripple effect on the treasuries for a country that's running multiple deficits, I think that has enormous ramifications, and I think other officials will be quick to address this.
I know you're leaning to where the market is interpreting this morning, and that is very much the view. But the point I would make is that when is the president ever not obvious about anything? If he wants a weaker dollar, he'll just say a weaker dollar. If he wants a strong dollar, he'll say he wants a strong dollar. The fact that he's made these comments that really don't lean either direction, I think highly unusual for him. He's never been afraid to call what direction he wants something. I mean, look at the US interest rate story. He wants lower interest rates, he'll call for lower interest rates. Why is he not being more obvious when it comes to the dollar trade?
I'm going to come back. I think he is being obvious, because I think when he was saying, look at what we're selling, look at our exports, we're doing great, I think that he is looking at this as a gentleman who is used to selling stuff in his life. That's what Donald Trump has done. That's why he was on The Apprentice. That's why he's what he is, and that's how he sold himself, as I sell stuff. I'm really good at selling stuff. I'm the master of the deal. I think he's making a very clear point that he wants to. I think he's saying, I'm very happy with a lower dollar because it means we can sell more stuff cheaply.
Yeah, it's just the quotes that I've been looking at this morning, and I have questions around that. But no doubt the president will again weigh back in, and we'll hear more. But here's the reaction we've had so far. The dollar index saw its sharpest one-day drop since April, slipping to a 4-year low. Sterling and euro, meanwhile, climbed to their strongest levels against the greenback since mid-2021. The latest pullback came after comments from US President Donald Trump ahead of an event in Iowa when he was asked whether he was concerned about the dollar's slide. The US leader disagreed that the recent leg down was too much, saying it was great, and comparing the export benefits to those seen by China and Japan amid currency weakness. Austria's central bank governor has said the ECB would need to consider another rate cut if the euro continues to gain and starts to affect inflation forecasts. And don't forget, it was a one-off adjustment that we were talking to ECB Governing Council members about last year, so this is no longer looking like a one-off adjustment. Coker said that recent gains against the greenback are modest and don't currently require a response, but pledged to maintain full optionality on policy moves. Gold is also continuing its run, now surging past $5,200 an ounce on some of that dollar weakness. Deutsche Bank saying in a note it expects the precious metal to break the 6,000 mark this year, but that a move towards $6,900 per ounce by year end would be consistent with its performance over the last 2 years.
So the Federal Reserve will take centre stage later today, although less for its rate decision and more for the political storm surrounding the DOJ's investigation into Chair Jay Powell. Analysts expect Mr. Powell to avoid any comment on the subpoena, though. Funny that. Also hanging over the meeting is the question of Powell's successor, with prediction markets, which have become more of a thing, haven't they? We can talk about that a lot in coming shows, putting BlackRock's fixed income chief Rick Reeder in the lead, which is surprising because he's not called Kevin. Meanwhile, the FOMC, is expected to hold, keeping its benchmark rate at the 3.5 to 3.75% rate. Let's have a look at the futures for the market, and we are on the Nasdaq, called higher. Elsewhere, the S&P 500 called 0.4% higher. Right, let's get to the most excellent Neela Richardson, who is chief economist at ADP. Neela, I don't know how much of our initial conversation at the top of the show you caught from Milan. We're gutted you're in Milan, but we're glad you're on the show. We want you here. But just tell us what just if you may, before we go into other nuances about the US economy, what do you think about the dollar and the historical perspective from various administrations? Karen and I are desperate to hear your thoughts.
Well, I think what you both in your comments have underlined is the uncertainty of the policy right now. And that uncertainty has marked the dollar markets, at times the bond markets, and certainly the uncertainty spills into the Fed decision today and the response to that Fed decision. So if you capture the U.S. economy, if you knew nothing about the last year, but just saw the headline numbers, the unemployment rate, which is low, the third quarter GDP growth rate, which is high, productivity, high, you would capture a very strong U.S. economy that would suggest a stronger dollar and an interest rate policy that was not going lower. But that is not where we find ourselves today. And I think what your comments reflect is the uncertainty of this moment.
That is a great point, Neela, isn't it? I think the market's trying to put together the policy initiatives and approach we've had from the Trump administration, the independence question from the Fed, which of course impacts the safety of the US dollar, the tariff uncertainty that we've had, and this interest rate call that interest rates should be much lower from here from the White House. I think the market's putting that together with the comments that Trump made that didn't really suggest much about a weak dollar. What is the consequence of a weak dollar from here? What do you think that does for the US economy if it continues in this vein in 2026?
I think you've captured it. I mean, a weak dollar is kind of a double-edged sword, right? A weak dollar does make U.S. exports more competitive abroad, but a weak dollar at home doesn't always have the confidence of markets. And that confidence is going to be very important as we look at other things that are a struggle for the U.S. economy, like sticky inflation, like high deficits and debts, and the need to sell treasuries both domestically and abroad. And so this puzzle of the U.S. economy has become increasingly complex. The headline numbers, as I mentioned earlier, don't tell the whole story. And that dollar weakness is a sign of the fraying of that story, even though the headline numbers objectively are strong.
Neela, the most interesting, frustrating element here could be sticky inflation. The hawks were concerned about it last year. There are fears that the tariff impact could still be filtering through. And as we talk about a weak dollar, that could also thwart the ability of US consumers to see cheaper prices. So if that is the case, and we're looking at a 2026 where the president is still trying to decide his pick to be the next Fed chair because he wants someone who's going to be leaning towards lower interest rates, what is the potential for sticky inflation to get in the way here?
Sticky inflation is something I think was always going to be a struggle, and I think it's going to be important. It's not just the inflation levels now; it's the accumulation of inflation over the last 3 to 5 years, which is double the pace that Americans are used to seeing. So, consumers, they don't look at inflation rates, they look at price levels, and those are not going down. And so you hear on the streets of the United States this question of affordability. So even though inflation has gone down quite a bit, it's still not at the Federal Reserve target. And what consumers are responding to is the cumulative effect of inflation over the past few years.
Neela, let's get back to your wheelhouse as well. When I look at, well, there's all your wheelhouse, to be fair, but the jobs market as well. GDP now, 5.4%. It's a great figure. Productivity numbers, the most recent, were a great figure. The unemployment rate of 4.4% is not a disturbing figure. So why are we all so worried about consumer confidence and the data being absolutely awful last time round? Consumer confidence collapsing to its weakest level in more than a decade. Just tell me what's going on beneath the surface in the jobs market, Neela.
I can tell you in a letter, it's K. It's a K-shaped consumer spending pattern where the top 20% of income earners are driving most of the spending in the United States. And the lower quartile of consumers are struggling over the higher pace of inflation. The numbers look good, but underneath the surface is where all the action is. And even if you look at the labor market is reflecting that K-shaped consumer, where we're seeing hiring in healthcare services, which are expensive services in the United States for most consumers, and leisure and hospitality, which is a discretionary service for all consumers. So if you are well-heeled, this economy is great for you. If you are not, it's a struggle.
What does it mean for interest rates, Neela? There are a lot of detractors in and outside of the administration who do think the Federal Reserve is too slow. If 80% of America, you mentioned quartile, I think there's a couple of quartiles in there that are struggling on. I think the downward leg of the K is pretty fat. And I'd agree with you about the disparity in the US economy. Is the Fed moving too slowly then, given the fact that a lot of Americans, again, whatever quartile it is, are absolutely suffering at the moment despite the great headline figures?
Traditionally, the Fed has moved slow, deliberately, modestly, and moderately. And so what we've seen over the last few years, when you see a 50 basis point move in either direction, that has been the outlier. I think what's the struggle for the Fed is that they are confronting things that are structural, not cyclical. There are structural changes to the US labor market, which are being reflected, that the Fed has no ability to adjust. They live in a short-term world. They work with short-term bonds, not long-lived. And what we're seeing is demographic change and productivity changes that are affecting the structural U.S. labor market. And so that is a fiscal policy concern, but we are always looking to the Fed to kind of drive the monetary policy. Unfortunately, the structural parts is not in their bandwidth.
Neela, I want to pick up on those points around the job market and what's coming. The boss of Manpower last week saying, look, AI is not disrupting the labour market at scale yet. The CEO of Anthropic saying, look, an unusual, painful short-term shock is coming to the labour market. How do we think about bracing for impact around AI?
Yeah, that's a great question. I spent a lot of time last week in Davos discussing that question. I think AI's impact is not going to be seen at a high level in the labor market. In fact, we have to think about AI's impact actually affecting what we do in a day, not necessarily the jobs that are created, at least in the short term. But our own research with Stanford University shows that AI is having an impact in some careers, especially early career, young people. And in the United States, it is taking longer for young college educated workers to find jobs. Now, whether that's all AI or if that harkens back to these structural changes in the labor market I mentioned. It's too soon to tell, but there is some impact that we can actually measure. And so it's important to engage early career and young people in this labor market. Those are the ones that look to be most vulnerable right now.
So Neil, if I can piece that together, it sounds like you don't think there's a massive shock coming. In fact, it's going to be productivity gains, which sounds positive for the stock market, positive for the US economy.
I think that the U.S. economy is strong in terms of the macro detail. And I think one of the reasons it's strong is because of this K-shaped economy in which wealthy consumers continue to spend and AI investment that has elevated the stock market. My concerns, though, is this is a highly concentrated U.S. economy. The job gains are concentrated in two sectors. Broadly speaking, we are not seeing hiring growth. My concern is in the stock market. It is highly concentrated in 7 tech stocks. We're not seeing the kind of broad gains that I would like to see in the equity markets. And so the narrowing of wealth creation in the United States is a concern because it makes us more vulnerable to the shocks that you mentioned.
Neela, we started off the show and you were observing Karen and I's conversation about the president's supposed indifference maybe to a weaker dollar and the ramifications. We've got Scott Besant on the channel later on as well. We're also obviously going to hear from the Fed chair as well. Do you think we're at the stage yet where policy members or administration members are actually going to have to start defending the dollar?
I don't think so yet, though. If the dollar slide continues, I think that's going to be a real concern. Right now, it's early on and I think a weak dollar has been a concern for several months now. But unless it becomes an ongoing factor in U.S. competitiveness, I don't know if those comments will be necessitated by current economic conditions, which are overall solid. However, I have not been a great predictor of public comment recently, especially by the administration or policymakers. So I'm going to reserve the right to be incorrect on this and what will be commented on later today.
Neela, we heard last week that we might be getting close to knowing who the next head of the Federal Reserve would be. It could be this week, but it seems like there's still a lot of pondering. Trump has 4 candidates from Hassett to Walsh, Waller and Ryder, but it sounds like none of them are perfect. What's the market weighing up as the perfect candidate of the 4 that have been served up?
The market seems to shift. I think what's popular this week and what's popular last week often doesn't match up. I think the 4 candidates have been at times front runners. Each one of them have been front runners. I think overall, though, what the markets really yearn for is an independent Fed. And hopefully that's what they'll get.
Neela, I have to say you did make me chortle there as well. I have not been a great predictor of policy commitments by the administration or comments by the administration. I think perhaps you can wear that as a badge of honour, because if you could have predicted, that means you're in the president's head, which would be an extraordinary place to be. Neela, we adore having you on the show. Thank you very much indeed. Have a great trip to Milan. Yeah,
fabulous conversation. Thanks so much, Neela. Our US colleagues, as Steve just highlighted, are going to be speaking to Treasury Secretary Scott Besant later today. Don't miss that first on CNBC Conversation coming up at 3 p.m. London time. Ahead on the show, luxury giant LVMH beats sales estimates but warns geopolitics may cloud its outlook. Charlotte's going to have the numbers for us. Plus, the earnings roll on thick and fast here in Europe, with ASML reporting a massive boost from AI demand. And the big tech earnings kick off stateside after the bell. We'll look ahead to what to expect from Tesla with former board member Steve Wesley.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
French luxury group LVMH beat fourth quarter sales estimates but warned geopolitical worries could hit in around the luxury sector. Organic sales at the company, which owns fashion labels such as Louis Vuitton and Dior, came in at 22.7 billion euros, up 1% on the year. The group's full-year operating profit also topped expectations, despite falling 9% amid weakness in its fashion and leather goods division, as well as wine and spirits. CEO Bernard Arnault warned that ongoing geopolitical tensions made it difficult to provide a clear outlook.
I always say that in our businesses, I am optimistic in the medium term, but short term, it's very difficult to provide a serious forecast. So many events and the pace of decisions taken left and right in the various countries, it's extremely difficult to control all these geo-economic impacts on our companies. One thing I'm sure of is that the desire for high-quality products goes hand in hand with growing living standards in the world. And that's said to continue, even though there are up and downs in certain countries, some countries that are faring left well, but the global trend is there. So long term, we can be optimistic. And this year, there's no doubt that with continued geopolitical crises, with economic uncertainty, with the policies of certain countries, our own, that are against companies to tax them to the hilt and create unemployment, I think there's a reason to be somewhat reserved.
Well, Charlotte joins us now live in studio. Charlotte, no doubt very cautious guidance there, but the market seemed to change its opinion in the third quarter. We saw better numbers rolling across the tape in China, and that seemed to give the impression that, look, some of the bad news may be behind us. What did you hear out of the latest earnings outing that suggests that, look, things are actually travelling in the right direction?
Yeah, when it comes to China, what we heard from LVMH last night is similar to what we heard from Burberry and Richemont that have already reported this quarter. Things are on the positive side, up 1% in Q4. So, showing that the trend is positive, not completely out of the woods, but certainly going in the right direction. Overall, these numbers better than expected there from LVMH. Looking at the divisions, fashion and leather down 3% in Q4 on an organic basis. An improvement on the 2-year stack. So the analysts are pointing this in particular. They see that operating margin at 22%. So that is holding up. They said the cost discipline is paying off there at LVMH. It's at 35% the margin for fashion and leather. So when you buy these bags, this is where they make the big margins, 35% there. So better than expected on that front as well. Watches and jewelry, of course, like what we heard at Richemont, the owner of Cartier. This is a segment in luxury that is doing the best. That was up 8% in Q4 there with their brands like Tiffany there at LVMH. The one day suffering is wine and spirits. We've seen that in many, many quarters, down 9% in Q4, operating profit down 25% overall for that year. We know it's a segment where they struggle a little bit more with the questions of tariffs and things like that. They don't have the pricing power in that segment as they have in other parts of their luxury portfolio. Cognac organic revenue was down 12% overall. Champagne holding up a little bit better. They were talking also changes in consumption overall that is impacting that division. So, the long term, they're putting a lot of work. They have a new CEO who's the old CFO of the company. So they have a big restructuring work happening in that division. But at the moment, things are still quite difficult. Now, overall, what we hear from analysts that we know that the groundwork has been happening at LVMH. A lot of new creative directors have been put in place. The tight cost control is still going on. As you see, the new collections from Jonathan Anderson at Dior that is creating a little bit of a buzz. The products are just starting to hit the stores. You have new blood at Givenchy, at Fendi. So all this, is potentially bearing fruit in the future. But we heard these words from Bernard Arnault last night, being very cautious about geopolitics. And as we've seen the roller coaster in the shares for a lot of the luxury stocks, they take the brunt of this. When there's a lot of uncertainty, the luxury stocks take the hit.
I think there's another issue, and it's something you scratched on yesterday when you were talking about how easy it was to create luxury brands, but you're talking about the car market. If you really dig into the numbers around LVMH today, where you see the sizzle is around the creation of new brands. I mean, Rhode, this is the Hailey Bieber brand that's been selling out at Sephora's. It's really attached to her celebrity status. It's not a legacy brand by any means. That's where the sizzle is coming through, these brands that have just cropped up out of nowhere.
Yeah, in beauty in particular, particular, you're right, so Rode at Sephora, and that's why, Louis Vuitton launched their own beauty brands as well, as part of the Vuitton, those very expensive lipsticks that we talked about before. So, we know that beauty has been a way to also access the aspirational buyer because they've been priced out very much. There's a repricing element happening for a lot of the luxury houses to try to rebuild a bridge to some of the aspirational buyers because they've been priced out too aggressively. So they're working on all this, but certainly, there is still some question marks of going to the future for this luxury, because as soon as a bit of uncertainty, this is where we see the hit happening when it comes to
especially for a young audience that actually don't need makeup. I mean, we've got how many daughters between us? 5?
Thousands of makeup products do we have between those daughters?
I bought my wife a small gift from Davos for looking after, holding the shop for a week when I was in Zurich Airport. And she said, whatever you do, don't tell the girls.
Yes, they vanish very quickly.
Yeah, the theft going on between our bedroom and my 2 daughters, it's like World War III sometimes if someone's stolen someone else's clothing or beauty product. Thank you very much indeed for that.